The $500 billion uranium rejection that crashed France's economy. Is it possible for a single governmental decree issued thousands of miles away in the African desert to jeopardize the foundational stability of a major European economy? Can the termination of a decades-old mineral agreement truly carry a price tag measured in the hundreds of billions? A financial shock so profound it threatens to derail national budgets and rewrite global energy alliances? The narrative surrounding the recent uranium rejection by Niger, a former French colony, is one such epic defining event. While the figure of $500 billion may represent the colossal estimated cumulative cost of replacing the lost supply, overhauling France's aging nuclear infrastructure, and managing the subsequent market instability, the true story is less about an immediate economic crash and more about the brutal, sudden exposure of a deeply ingrained post-colonial dependence. This moment of resource nationalism did not just impact a supply chain, it exposed the vulnerability at the core of France's celebrated energy model and redefined the delicate balance of global energy security, proving that resource sovereignty is the new battlefield of global economics. The architecture of atomic power, France's nuclear dream. To understand the magnitude of Niger's rejection, one must first grasp the centrality of nuclear power to the French state. Following the oil crises of the 1970s, France, lacking significant indigenous fossil fuel reserves, embarked on the ambitious Mesmer Plan. This sweeping national initiative aimed to secure the country's energy independence by transitioning rapidly to nuclear power. The plan was executed with military precision and engineering standardization, resulting in a system where, for decades, approximately 70% of France's electricity has been generated by its fleet of pressurized water reactors, PWRs. This commitment made France the world's largest net exporter of electricity and conferred a massive competitive advantage upon its industries, which benefited from some of the lowest, most predictable electricity prices in Europe. The uranium cornerstone, Niger's unseen role. For over 50 years, Niger, a landlocked nation in West Africa, served as the indispensable cornerstone of the French nuclear enterprise. Niger, often ranking among the poorest countries in the world, ironically possesses some of the globe's largest and richest uranium deposits. Shortly after Niger gained independence in 1960, the French state-owned nuclear giant, now known as Orano, formerly Areva, established mining operations, primarily through subsidiaries like Somaïr, Société des Mines de l'Air, and Cominac Compagnie Minière d'Akuta. These arrangements, forged in the immediate post-colonial era, were systematically criticized for their perceived inequity, the inevitability of resource nationalism, and the coup. The simmering discontent over resource exploitation came to a head in late 2024 and early 2025, following the military coup d'etat in Niger in 2023. The military government, led by General Abdourahmane Chiani, swiftly moved to solidify its power through acts of resource nationalism, seeking to dismantle the economic pillars of French influence. The popular sentiment, fueled by years of perceived exploitation, provided a mandate for aggressive action against foreign resource control. The rejection was manifested in a series of calculated strategic moves. First, the junta suspended uranium exports, and shortly thereafter, in a landmark decree, it revoked the permit for the massive Imararan mine, operated by the French giant Orano. Imararan, one of the largest undeveloped uranium deposits in the world, estimated at 200,000 tons rate, represented France's future guarantee of supply. Unpacking the $500 billion economic shockwave, the sensational figure of $500 billion cited in the context of this rejection is not the cash value of the canceled contracts, but rather a calculation reflecting the comprehensive, systemic cost to the French economy over the medium to long term. This figure encompasses several critical components. 1. Replacement cost and market volatility. The immediate loss of guaranteed supply forced France to scramble for replacement uranium on the volatile global spot and long-term markets. The Niger crisis significantly tightened the global uranium supply-demand deficit, pushing spot prices upward, a trend already accelerated by global energy concerns and the Ukraine conflict. The cost of securing multi-year contracts from alternative, often less reliable, suppliers like Kazakhstan, Australia, and Canada at significantly higher prices than the preferential rates previously secured from Niger runs into billions of euros annually. The long-term contractual inflation alone contributes heavily to the cumulative $500 billion estimate. 2. Nuclear fleet overhaul and extension. The uranium shock coincided with an existing domestic crisis in France's nuclear sector. Decades of underinvestment, technical issues such as stress corrosion, and delayed maintenance had forced numerous reactors offline, severely curtailing domestic electricity production in recent years. 3. Budgetary strain and debt acceleration. The increased cost of nuclear fuel, coupled with the massive state spending required to stabilize and rebuild the domestic nuclear fleet, directly exacerbates France's national debt and budgetary deficits. France's government had already faced intense political pressure and public outrage over austerity measures aimed at finding tens of billions of euros in cuts. 4. Loss of geopolitical leverage and soft power. Beyond direct monetary costs, the rejection signals the rapid decline of French influence in the Sahel, a region where it had maintained security, military, and economic dominance since the colonial era. The loss of Niger's uranium is a public, humiliating blow to France's diplomatic standing. The economic cost of losing this sphere of influence, measured in diminished trade opportunities, loss of strategic partnerships, and increased competition from rivals like Russia and China. Geopolitical repercussions in the new energy map. Niger's decision was not an isolated incident. It was part of a broader, accelerating trend of anti-French sentiment and military takeovers across the Sahel, Mali, Burkina Faso, and Niger. The unified rejection of French military and economic presence across the region signals the rapid fragmentation of France-Afrique and the emergence of a new African alignment. The dawn of resource sovereignty. The $500 billion price tag attached to the Nigerian uranium rejection is not an arbitrary figure. It is the calculated long-term cost of French exceptionalism coming face-to-face with the reality of resource sovereignty. The crisis did not instantly crash the French economy, but it delivered a catastrophic shock that accelerated existing budgetary woes, escalated the essential costs of maintaining its nuclear fleet, and permanently disrupted the foundational assumption of its energy security: a cheap, guaranteed supply from former colonial territories. If you found this detailed analysis insightful and want to stay informed on how global events like this reshape major economies, please take a moment to like this content, subscribe for more in-depth geopolitical and economic breakdowns.